to possibly win Best Picture of the Year is a movie called The Big Short, taken from a book by the same name. I read the book a couple of years ago, and I read it 3 or 4 times, 3 or 4 different pages at a time, trying to figure out exactly how the economy tanked and what happened. They then turned it into a movie, which I think does a really good job of actually trying to explain it. But there are parts of that movie that still I get lost because it's still so confusing. So we thought we would go to the best person I know who can help explain all of this stuff, and his name is Scott Colbert, friend of the show with Commerce Bank. Good morning, Scott Colbert.
Hi there. How are you, McGraw?
Good. What's your official title over there?
I'm the chief economist and the head of fixed income.
All right, good. So you know a thing or two about a thing or two. You have read the book?
Yes, I have.
And have you seen the movie?
Yes, I saw the movie because you asked me to talk to you today. I actually went and saw the movie yesterday.
All right, good. Overall, as a theater critic, did you like the movie?
Yeah, having read the book a couple times, everyone always tells you the books are better than the movie. But the movie was pretty interesting, and gave an audience kind of the theme of the mortgage market was imploding, and a few guys got it right.
Right. Yeah, and so the book and the movie are very different, but I think the movie they go above and beyond the Call of Duty, trying to explain it to laymen in layman's terms. You would agree with that, right?
Sure, they've got the little stars that pop in there. I'm not sure who the blonde lady was in the bubble bath, but yeah.
Yeah, good answer. Her name is Margot Robbie. Yeah. Your wife is clearly listening.
Yeah, that's the one I certainly remember.
All right, let's start at the beginning. Mm-hmm. Very simply, because it is very confusing, and so I apologize if this is rudimentary to some people, but it gets convoluted pretty quickly. A company sells a share of stock. I buy that share of stock for $10, and at some point in the future, I hope it goes up. If it goes up $5 and I sell it for $15, I make $5. That same stock goes down to $5. I sell it for $5. I lose $5. That I get, okay?
Right.
Now, let's talk about selling short just on a stock. Mm-hmm. So I sell a stock, and somebody gives me $10 for that stock?
I mean, GE right now is trading around $28 a share. And you can wake up this morning and decide that you either want to own GE and hope that it goes up, or you can say, you know what, I think that the whole market is in trouble. I think the dollar is going to strengthen. I think GE's earnings are going to be weak because they sell so much overseas. And so I want to sell GE. So you could sell GE without owning it, and you can do this in your TD Ameritrade or your Schwab account if you have a margin account, and you simply put in the sell order, and then magically the money shows up in your account. You sell the security, and the money shows up in your account. Now you have the money, but you have to buy back GE or deliver GE at some point because you've sold it now.
How long do I have before how long before I have to buy GE?
For small investors, really it's almost an unlimited amount of time unless there's, kind of a squeeze on the shares. And with GE, you can always borrow the shares, so there's a lot of shares running around. But if you do it with an illiquid company, a small company, the brokerage firm might say they don't have any more shares to lend to you to sell. You now have to cover and you have to buy back. So there's a little bit of risk there. But in general, for most of the large cap stocks, you can short them and you can keep that short as long as you have the money in your account to cover the losses that you might be generating.
Okay, so the losses are generating. So in other words, if that share goes up,
right,
I've got to have money in to cover it to buy it.
Well, if it goes up $5, you've just lost $5 a share because you sold it at 28 and now it's 38.33.
Right.
And now you're down $5.
So I need to cover that in my account?
Eventually. I mean, if you don't have enough money, typically a margin account lets you put, we'll call it for round numbers, 50%. So, you could, as long as you have $14,000 in your account, you could sell 1,000 shares of GE short. So you could sell $28,000 as long as you've got $14,000 in equity, or kind of a 1-to-2 ratio. And that's an approximate. Sometimes you can get down to 25 and 40% ratios depending upon your account.
Okay, is it true that Joseph Kennedy invented selling short?
I don't know that for sure. I don't know.
Okay, all right. So
I doubt it. I imagine that people have been shorting things and selling things. If you think about gold, people used to store gold for other people, and the whole banking system was kind of created on this idea because, you gave your gold to a bank, and then a bank would lend out the gold, and then you'd find out the banks were lending out more gold than they actually had. So if you think about it, years and, I'm talking about thousands of years ago, the banking system was kind of invented on this whole idea of lending money where it didn't even really exist.
Right. And I know in the farming industry, people sell their grain of corn before it's ever planted into the ground.
Absolutely. The old rule of thumb was you sold a third before you ever planted it. You sold a third as the season went on. You sold a third when it finally came to fruition. Just to kind of cover your bases. You didn't know what the price of the corn was going to be, and this way you could kind of, average into the price of corn as the year went on.
Okay. All right. So that's selling short just with a stock. Now, take us through at least the next step is how the mortgage companies and how we all got our mortgages at such great prices through the 90s.
Yeah, I mean, you had a combination of things all happening at once, but what really started it was, the lowering of interest rates post-2000 as interest rates came down and down, and basically post 9/11, where you had your tech bubble and you had the Federal Reserve lowering interest rates fairly quickly. So we all had an opportunity to basically borrow money at what felt like once in a generation type interest rate levels. So just nominal interest rates were low. Secondly, there was really a push from the government to encourage people to buy homes. We've always heard that owning your home was the way to wealth, and I think still most people would still agree with that, provided you have the income and the stability to afford that house. And so credit standards began to get lower and lower and lower, and with low interest rates and widening credit standards, more and more people could buy houses. Typically, historically, you had to be a semi-prime borrower or nearly prime borrower, meaning you had to have an awfully good FICO score, you had to have 20% down, you had to meet debt-to-income requirements, and you had to be able to verify your income to basically qualify for those mortgages. And those were the mortgages that Fannie Mae and Freddie Mac typically made. But Wall Street was able to step in, and basically it wasn't Wall Street at first, it was these, I call them mortgage brokers or mortgage-in-a-box lenders that would step in and basically, I would say, basically skirt some of the lending standards. And so the lending standards were going down and down and down, and Wall Street was able to take all those loans, I call them, put them into a bathtub, all right? So think of it, we call it a pool, but you put bundle the loans together, and they're able to sell off those loans to other investors, mainly pension funds, foundations, and endowments. And in general, they were getting AAA ratings out of these loans that they were selling. And so this all started out benignly enough, largely in 2000, 2001, 2002. But by 2007, 2006, 2005, the machine had gotten big. The lending standards were getting weaker and weaker and weaker. They were making loans that shouldn't have been made, and the defaults were, to some people, obvious and coming. And this is what the book is about, 3 different sets of people that saw this opportunity to say, listen, I want to short the housing market. I want to be on the other side of this bet. I do not want to be long this bull market in housing.
It was so brazen. There's a great scene in the movie where they go down to Florida and they're interviewing a couple of mortgage brokers, and then they sort of huddle afterwards, and Stephen Carell's character says, I can't believe they are just telling us all this. And the other one says they're bragging about how they're able to qualify people who have no business qualifying for a home.
Our favorite loans were the ones we called the ninja loans, and they mention it in the book. I'm not sure it came out in the movie, but that was no income, no job, or verifiable assets. So, basically the brokers, these brokers in a box, were able to sell the loans to Wall Street. And by Wall Street, I mean Goldman Sachs, Morgan Stanley, Greenwich Capital, or somebody like that. They would pay them $104, $105, $106, and in the movie they said they'd pay me $110 a loan. So for every $100,000 of loan, they were paying them $110,000, where they were making a lot of commission. And so if you think about it, people always do what is in their own best interest, and in these kids' best interest, these 2 brokers' best interest. It was better off to find a subprime borrower than it was to find a legitimate borrower for that house.
Why would somebody pay someone $110,000 for a loan that was only $100,000?
Well, because then they could take those loans, put them into their pool, and then sell them off to investors for even more money than that. And so, yes, it was just, I call it the chicken part theory of investment. We all know what the chicken kind of costs, but then they were parting it up, and because there were so many various parts and it got so complex that people were paying a lot more than the chicken as a whole was worth, because they were buying this part and that part and this, and then the CDOs that they refer to, and the movie did this with fish, right? The leftover fish from Friday.
Right.
But the parts of the mortgage that they couldn't sell, the chicken parts I refer to them, is what I say they turned into the chicken McNugget, right? Which comes out, and sorry about that for those McDonald's owners, but basically you're not sure exactly what's in a chicken McNugget, and that's the same thing. People weren't exactly sure what was in a CDO, a collateralized debt obligation, because those were the leftover mortgages that they couldn't sell directly from the first pool. So that's the first step of non-transparency was to take it out of the original pool and then put it into this secondary pool called a CDO. And it was these CDOs that these three different folks, the hedge fund manager from New York, played by Steve Carell, the doctor from California, I think played by Christian Bale, and the two kind of goofier guys, and I don't know who they were, but the younger folks that were running around, the three of them, that's what they wanted to do, was get short these CDOs because they saw that, the chicken McNugget, if you will, where the problems would likely
Got it.
home to roost.
Okay, so Scott Colbert with us from Commerce Bank, explaining the movie The Big Short to people like me who aren't smart enough to figure it out. Okay, so you have this bathtub full of loans. Standard & Poor's says that they're great loans, but we all know they're junk now. But at the time, the rating agencies rated them as good or great. They then sold bonds to them to then fund these loans that then went to the mortgages and so on and so forth.
Yeah, essentially, if you were a subprime borrower, you were actually getting funded by some pension fund, perhaps in New Jersey, or they always like to say to an overseas investor, because Michael Lewis's first book, called Liar's Poker, he was stuck on the desk at Solomon selling bonds himself, and he found that the places he could always sell bonds, particularly dollar-denominated bonds that didn't make a lot of sense to domestic investors like us, was overseas in Germany. And so a lot of these bonds ended up around the planet in hands because of the AAA rating, largely because of the ratings of the ratings agencies in hands of buyers that really didn't exactly understand. So, the ratings agencies were semi-complicit with basically, and they didn't mean to be, all right, but yet they were getting paid to make these ratings, so, did they look the other way? Did they think that home prices could fall? They never had, since basically the ratings agencies have been around. So, there was it's just kind of a perfect storm of willing borrowers, investors, lenders, and people that would buy houses at outrageous prices, knowing they didn't have the income to pay those loans back in the first place.
Scott, can you hold on through the break?
Sure.
Scott Colbert with us from Commerce Bank, explaining The Big Short, and we're at that critical juncture where I get lost. So this next segment is going to be very important. Scott Colbert, hang tight. We'll get to you in a second.